Hi everyone. Good evening. I hope you're all fine. And today we are back here. Um, for me, it's left with my last paper. Which is investing fundamentals. So we are still writing. I wish you all the best. And try your first project because this year or this semester we are doing everything. All right. So today we'll be solving tutorial sets for a set 3 here, which is investment fundamentals tutorial set 3. So um, it's it. All right, so let's not waste much time. Let's deal with this fast. Okay, so question one. Question one is saying that they should give at least two differences between buying on margin and then also buying on short sale. Hey, we should give two differences between buying on margin and then short sales, right? So that's it. We should give two differences, right? So basically, buying on margin is when an investor borrows cash or money or cash from a broker to purchase additional shares. So in this view, the investor is thinking or is speculating that the price of the stocks or the shares will go high or will increase. So he wants to buy it now and then sell it later when the price increases and then give back the broker's money to him, right? And then take the difference as a profit, right? So upon this definition, what we can clearly see here is that buying on margin involves borrowing cash, right? And also we are anticipating the market is going what? Is going to increase or stock price is going to increase. So one, borrow cash. Two, we are anticipating that the stock prices is going to increase, right? Whilst on short sales, what the investor does is that the investor borrows shares. The investor doesn't borrow cash. The investor borrows shares and immediately sells the shares, right? With the expectation that the price is going to fall, right? And then when the price falls, the investor what buys the shares at that lowest price and then make profits and then what give back the share to the broker. The shares that he borrow, give it back to the broker. So upon this definition, what we are seeing here is two things. We are seeing that in short sales, the investor borrows stocks. The investor doesn't borrow cash, the investor borrows stocks. And then here, the investor is also anticipating that markets or the share prices are going to fall. That's what we get in here. So we can put it here that buying on margin, investor borrows cash and also anticipates increase in share prices, right? Or in share price, share price. Whilst whilst short sales, investor borrows stocks and then anticipates fall in stock price. So that's it for the first, the one I. And then II is trying to say that we should briefly explain these terms with clear examples, right? The first one is late trading. So late trading is basically like an illegal act, right? That's investors place orders after market has closed. So it's more or less like placing an order after the market has closed. It becomes illegal, right? And then what they are anticipating is that they even though they place the trade at when the market has closed, they are expecting that the price they are expecting that they will receive the closing day price. So maybe for example, let's talk about real life, where let's say um you are going to buy something at a shop where that shop has closed because you heard something that, let's say, tomorrow the price of a particular item will increase. So you are going to the shop to go and then buy it now, right? And buy it at the current price, even though the shop has closed, because you are afraid that when you go tomorrow, the price is going to increase. So that's the same thing here. The same thing here is that the investor places the order after the market has closed, but still receive the day's closing price. So an example is that if, let's say, a market closes at 5 p.m. with a price at 6, and an investor trades at 7 p.m., the trade is activated with the same $6 price. So if tomorrow the price, let's say, has increased to 7, right, then the investor is going to get a profit on that, right? So that's it for the late trading. And then for market timing, it's more or less like looking at the trend of the market. So you are looking at the market and then you are seeing that the market has been moving up, 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 up. Then it is likely that it is going to move up, right? Then you also buy the stocks or the shares, anticipating that it will go up. And the vice versa is that, let's say you have been expecting a market has been going down, 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 right? Has been moving downwards. So you're expecting that the prices should be falling, right? Then you place it with a short trade, right? So that is it for market timing. And the example is what I've just said, that you anticipate, let's say you've been seeing that prices have been falling, then you also what sell the market. So that's what market timing. Looking at the trend of the market and then using it to place a trade. That's market timing. Then we also have front running. So front running is a situation whereby you hear that, let's say, not you, let me just go to the investment fundamental thing. So it is more or less like a broker trading ahead of a client, right? So let's say, you see, before you place a trade, normally you register with a broker, where the broker will be taking the trade on your behalf. So you tell the broker to, let's say, buy a stock for you, and then the broker will buy for you, right? So let's say a very big firm signs up with a broker, and then the firm is coming to place a buy trade on a particular stock. Because the broker knows that maybe this particular trade is going to affect the market big time, because this institution is coming to place a very big trade on the market, right? The broker goes ahead and then plays the buy trade for himself, right? The broker plays the buy trade for himself, buys the shares for, like let's say buys some shares for himself, and then later on places the investors trade, right? So you know that the market normally move with the concept of demand and supply. So when you buy, the prices are going to go up, and then when you sell, the prices are coming to will be coming down. So the broker, let's say, buys the stocks. Let's say the broker buys at two at $2 per share, right? And then because the investor is coming to buy, the investor also comes to buy with a very huge sum of money, which will actually shake the market or move the market upwards. So this might cause this price to also increase to, let's say, $6 per share when the investor places that trade, right? And then the broker is going to make a profit with a difference, right, of 4. Do you get it? So with this one, the broker places a trade ahead of the investor, because the broker has heard that this investor is coming to place a very big trade, which will what affect the market big time. So the broker will go ahead. Either the broker or another trader will go ahead and then place that trade first. waiting for that investor to place the trade and then benefit from it. So that is the front running. So it is also an illegal act, right? Because you don't have to do that. So let's move on to question 2. Question 2 says that describe how exchange traded funds, which is ETF, works, and then also elaborate on its advantage and its disadvantage. So basically, ETFs are investment funds that holds a diversified portfolio of assets, such as stocks, bonds, or commodities, right? And they are also traded on the stock exchange like other individual stocks, right? So basically, that's what they do. They hold a different kind of asset together, and then they trade them. So what some of the advantages of these ETFs are diversification, because they have different kinds of assets in there, right? They help to reduce risk by diversifying the portfolio, right? Because they're investing in different securities, right? They reduce the risk. And then also there is some form of liquidity, right? ETFs can be traded like stocks throughout the day, right? Allowing investors to trade shares at the market prices. So basically, ETFs can be traded throughout any time of the day, any time of the trading day, trading day. So you see, during the day, there are some times that the market will close and the market will open. So the trading times within the day, you can trade ETFs at any time, right? And it also have lower fees, right? Generally, ETFs have lower expense rates than mutual funds because they are passively managed, right? And also they are tax efficient. The reason here is that the unique creation and redemption process minimizes capital gain tax compared to mutual funds, which they have to sell securities when investors redeem shares. So in ETFs, you don't sell the securities, right? But for mutual funds, they sell the securities when an investor wants to redeem his or her share of the listing. So some of the disadvantages include trading costs. You see, we said that the ETFs can be one, traded anytime throughout the trading day. And then two, as an advantage, right? And then two, also have lower cost. But here we are saying it has what? A high trading cost. A high trading cost can occur when the trader places multiple trades within the day. Because anytime you put up a trade, you will be charged the fee. Anytime you put it up, you will be charged the fee. And then when it accumulates, it becomes plenty, right? So that is why we are bringing trading cost in here. And also there is price deviation because the ETF fluctuates anyhow. The prices moves up and down within the day, right? There might be some kind of what price deviation from its net asset value, which will lead to a potential inefficiency, right? And particularly this happens in like illiquid market. And we also have complexity, right? Some specialized ETFs are more complex and can carry high risk, especially for inexperienced traders like us. Also, it have some kind of market risk. So ETFs are subjected to market volatility, and the value of ETFs can fluctuate with the value of its underlying asset. We are done with the second one. Let's move to the third one. I want us to finish this fast. So the third one here is asking us, why is security market index useful? Right. So basically, security index is a tool that is used to track the performance of a group of securities, such as stocks or bonds, right, on the market. So that is what it is normally used for. And then the reason why it is useful is because it is used it is used for benchmarking and then performance management. You can use the security market index to benchmark and then check your performance management. And also, investors uses this to compare their portfolio performance against the market, which help them to make informed decisions. It also serves as a basis for constructing index tracking funds like ETFs. Additionally, they are often used as indicators for the overall economic health or investment sentiment. So what this point means is that if the security market index is bearish, then it means that most of the companies or most of the stocks, most of the shares of companies are what? Bearish, or they are also falling, right? And the vice versa. Also, the indices provides a clear way to measure trends and assess market conditions over time, right? All right, so that's it for question 3. Let's move to question 4, as I want us to go to the calculations. Let's talk about this first. So question 4 is saying that a price-weighted index places more weight on stocks with higher prices, whilst a value-weighted index places more weight on stocks with higher market capitalization, discussed. So basically, the price-weighted index only looks at the price of the stocks, whether you have 10 million shares or whatsoever. The price-weighted index doesn't care. So when there is a general percentage increase in the market, right? Those who have higher prices actually forces the index to move more than those who have lower prices, right? So when we go down here, we'll be solving an example to prove this, right? So what I can say is that for the price weighted index, they only look at the prices of the stocks, right? They don't look at the market cap, right? But for value weighted index, they look at the market cap, which is the market cap is basically the price and the number of shares, right? So they look at that to they put that in their indexes. So that's what moves the indexes. So a company or a firm with a big market cap will generally affect the index more than a firm with a lower market cap. So what I wrote during the tutorials was that a price-weighted index gives more weight stocks with stocks with higher prices, meaning that price changes in higher price stocks have greater impact on the index performance, regardless on the company's size. An example is the Dow Jones Industry Average here. In contrast, a value-weighted index assigns more weight to stocks with higher market capitalization, which is the same as the market cap, meaning larger companies has higher or greater influence on the index, even if their risk prices are lower. The S&P 500 is an example of a value-weighted index. So the key differences is that the price-weighted index focus on the stock prices, whilst the value-weighted index emphasizes on the market cap. So that's what I wrote during tutorial. So the fifth one. The fifth one is saying that price-weighted indices have been criticized because they introduce downwards bias by reducing the weight of a growing company whose stock split. What does this mean, and why does the underweighing occur? So first of all, what does it mean? What does stock split mean? So stock split means that uh, the prices are like the stocks are going to be normally increased, right? So let's say a firm has actually done well, like has been very, very efficient. And then the price has increased from uh, let's say from 500 $2,000 per share. You can imagine how this will look like in here. Maybe with this one, they were having, let's see, 50,000 shares, right? So what the firm can do is that since price has increased to 1,000, right, and it will not be actually attractive for investors to invest in this particular firm because the price is what's high. So what they can do is that they can reduce the price back to 50, and in that can increase the number of shares they have, right? So basically, what they can do is that they are going to uh, do a stock split of 2 for 1. For example, let's say 2 for 1 or 3 for 1 or whatever. So if 2 for 1, then what it means is that the stocks now is going to increase by 2 because it is 2 for 1. It is going to increase by changing towards 100,000. And then now the price is going to change towards 500 again. Right. So with this one, we can see that the number of shares has increased, right? So for example, if here we multiply the 1,000 by this 50,000, we are going to get 50 million, right? And then the same way, if we multiply this by this after the stock split, we are still going to get 50 million. We are going to get the same 50 million, right? So that's when the stock normally, this is how the stock splits normally happen. So the question here is that they're asking us, the price weighted index criticizes the price has been criticized because they introduce a downward bias. Yes, the reason is because even though the firm has increased in value, right, in terms of value, but because of the stock split, so the price hasn't actually shown, say, the stock has what increased in value. So it's what brings up something like a downward bias to this one. So if let's say another company is there, which is having, let's say, 70,000 shares, right, with a price of, let's say, 600. It's a price of, let's say, 600. The price weighted index will judge this particular firm to be performing well, or when the price of this particular firm changes, it's going to affect the index more than the 500, even though in general the 500 stock is performing well. Do you get it? That's why it criticizes it, and then it has something like a downward bias towards it. So the English I've written here is that the criticism of price weighted index is the criticism of price weighted index introducing a downward bias relates to the effect of stock split. In price weighted, the weight of a stock in the index is solely determined by its stock price. When a company whose stock is part of the index experiences significant growth, its stock price may rise. However, if the company decides to split its stock, example 2 for 1, the stock price is halved, which is it is divided into 2. I like the same way I use the 1,000 here. Even though the company's total value remains the same, even though the company's total value still remains at 50 million, right? In price weighted index, this reduces the stock price, causing this reduced stock price causes the stock to have a lower weight in the index. Following the split, even though the overall value and potential growth is unchanged. This creates a downward bias because growing companies that split their stock often growing companies that often split their stock is because they have what increased or they are attaining success are underweight compared to other stocks that have not splitted their stock. compared to others that have not splitted their stocks and may have higher price regardless of their growth or market value. So I'm just trying to read what I've explained here right now, here, according to how I've penned it down, right? So this underweighing occurs because price-weighted indices only consider the stock prices and ignore the company's ever or size, or it ignores the company's size or the market capitalization. Therefore, companies that perform well split their stock may have less influence on the index performance than that of those who do not actually split their stocks, right? So that's why we are seeing this. So that's whatever I've explained here is what I've read out, right? I hope it's understandable. If you don't understand it, you can also drop a comment in the comment section, and then I'll be also there to um, give you more insights or more explanation. So kindly like this video for me if you are here, and then also subscribe to my channel if you are new to this channel. Thank you very much. Let's move on to the seat one. So the seat one where our normal action starts, but take note, all these are important, right? All these are important. They can come in the exams, so don't joke with any. If you can get time and also solve them yourself, it will also be beneficial. So, question 6. The table below gives information about 3 stocks in T1, but I'm sure it's a mistake. It did here. It's rather 4 stocks. So, yeah, they will adjust the rest. So, stock A increased by 20%. So, in T1, right? Stock A, only stock A increases by 20%, while stock B, C, D remains unchanged. Now, in T2, the price of stock B increases by 20%, whilst stock A, C, and D remains the same. In time T3, the price of stock C increases by 20%, while stock A, B, and D price remains unchanged. In time T4, stock D increases by 20%, whilst the others remains unchanged, right? Now, they are telling us to calculate the price weighted index in period T and period T1, T2, T3, T4. Sure, it continue. Then what does this tell you about the price weighted index? So whatever we will do here will give us insight about what, or the explanation I've given up there roughly. So now I'll be using Excel to do this, but I'll be explaining and writing before I'll solve. So let's pick up. Let me see whether I can pick exactly this Excel. Let me get to this. So in exams, if this kind of question comes, this what the TA taught us to do, right? So you draw a table, and then you bring your stock here, then you bring your period T, Then you bring period T plus 1. Then you bring your period T plus 2. Then you bring your period T plus 3. Then you bring your period T plus 4. So let's bring our stocks here. A, B, C, and then period C. The stocks are, the prices are 100, 80, 50, then 40. Then we bring a sum here, meaning we are going to sum them. So a sum will come here. Sum will come here. Then we also have a divisor here. Then here will be average, which is the index one. Then we have percentage change. Yeah. So this is what we are going to add to the table that's already there, right? So now let's go here. So let's look at it here. They are telling us that for period T plus 1, A increases by 20%, whilst B, C, and D remain the same. So we are only going to increase A by 20%, right? So increasing A by 20% is going to be 100 times 120%, or 100 times 1.2. That's going to get the same answer, right? So when we do that, we are going to get 120 here, save 120 here, right? So that is period C plus 1, which says that stock A increases by 20%, right? So that's it here. This is going to be equal to this times 1.2, right? About 120, while the rest is the same. So 80, 50, 40, right? And the sum here will be just the summation of all these. So 100 plus 80 plus 50 plus 40. So equal to sum bracket and sum of that. And then this will also automatically, we are going to sum all these also. Right. The first one is 90, a 290 here. Now, period C plus 2 is saying that only B increases by 20% and the rest remains the same, right? So B increases by 20%. So if B will increase by 20%, what it means is that we are going to multiply B's price by 1.2, right? And B is what? 8. So 80 times 1.2, right? So that's what we are going to do here. So 80 times 1.2, 96. Or 80 times 120, 226. Or 80 times 120%. Sorry, it's going to the same. Yeah. So 120, while the rest remain the same as T. So we are still going to maintain T's price of A. So it's 100. Remember, it is here, it is only B that is increasing. So we will change only B, but remain or maintain the same thing as period T. Not as period 1, not as period T plus 1, only as period T. So equal to 80 times 1.8. Sorry, right? Whilst we have period 3 to be the same, then period 4 to be sorry, I get. Now let's move to T plus 3. So in period T plus 3, period T plus 3, say that C increases by 20%. Only CU, whilst the rest remain the same. Right, so C was 50. So 50 times 1.2 is going to give us 60. We come and put the same thing there. 60, whilst the rest remains the same. 100 as period T, 80 as period T, and then 40 as period T. Right? Now, count to period T times 4, 80 plus 4. Now, with that one, D increases, only D increases by 20%. By 20%. And D is what? 40. 40 times 1 point. It's going to be 44. So only D 44. While the rest remain the same as period T. 50, 80, then 100. Remember, don't get confused though. Whenever the period, whatever will happen in the period will only happen to only one stock, whilst the rest will look like period T. This one, only one stock, the rest will look like period T. This one, only one stock, the rest will look like period T. So now this is the summation of all of them here. Adding all of this, adding all of this, adding all of this, adding all of this, adding all of this. Right. Now the divisor here is 4. Which is the number of this thing. 1, 2, 3, 4 here. That's the average thing here. Right. So we're going to put 4 here. Then the 4 will spread across all of them. Then we have average. Average is basically the sum over the divisor, either average or index, right? The average or the index. So let me just put index. So the average or index. So index or average. is going to sum over price, right? So that's what I'm going to get in the Excel. So this is going to be equal to this divided by this. Enter. And it's going to affect all of them. So this one to the sum divided by this one to this divided by this one to this divided by this one. All of them divided by. That's it here. And I want to find the percentage change. So all the percentage change that we are going to find will be compared to only period T. So when you find percentage change of period T, you compare it to period T. Even period 3, you compare it to period T. All of them period T, right? So let's look at something. Percentage change. T can be period T plus any of them. So question mark, any of them minus ET or period T. Same. All over ET times 100%, right? Or what I like to do is normally I take period T plus any of them all over ET the period T minus 1, or multiplying by 100, and you still get the same thing. You can either use this, which is period T plus either 1 or 2 or 3. So when you are doing for period T plus 1, you use period T plus 1 this thing. Then when you're doing for period T plus, you use period T plus 2's index. So period T plus 1's index or period T plus 2's index minus period T's index all over period T's index times 100%. Or you can take period T plus, maybe if you are doing for period T plus 1, the period T plus 1's index all over period T index minus 1 times 100%. We are still going to get same thing. So let's do this in there. So now percentage change as let me use this one. So it's equal to period T plus 1. I'm doing for, okay, here will be dash, or here will be, okay, here will be dash. The dark side. Now, here is going to be equal to this. Okay, wait, let me do bracket. So it's equal to into bracket this divided by this, right? Minus 1 bracket close times 100. Let me leave the answer to two decimal place. So see what we are having here. This is what I did take. 17.5, which is period T plus 1 this all over 67.5, which is period T is this thing minus 1, all times 100. Remember, you put them in bracket before you multiply by 100. Or you can do the same thing by doing this. 72.5 minus 67.5 all over 67.5 times 100%. You're still going to get the same thing. So you can try any of these, and you're still going to get the same thing here. Any of them, you're going to get that same. So this or this, and put a very big or here, or this or this, get the same thing. All right. So with this one, you can drag and get it for all of it. So the reason why it is negative because I didn't take reference, absolute reference. You can make absolute reference using the first one to very that's it. The problem is 41.9 40. So these are all in the same. So if maybe let's remove this, remove this one. So the first one, for example, here, right here, grade T, you compare grade T plus one, compare it to grade one. Don't bring my calculator here. If you need this calculator to calculate me, I'll help you get it. Okay. So what I'm doing here is 72.5 over 67.5 minus 1. That's it. So when you run it, there's like plus right is 7.41, right? Then the next one here, right, will be 71.5 all over 67.5, 67.5 minus 1 times 100. to 5.9 by when we run it at 5.9. So the same thing. You compare this one also to period T. This one also to period T. Not this one to period 3, but period T, right? Or once the long way to, you can do it. For example, for period T plus 1, 72.5 minus 67.5 all over 67.5 times 100. Yes. Right. I don't like it printed like this. So that's why I do it in a simple one. So now we are seeing the percentage changes. Now, what does this tell us? You can see that because this one's price was high, right? This one is 100. When it was increased by 20%, right? Remember the percentage change is 20% for all of them. When it was increased by 20%, you can see the index increased by what? It's at 7.41, right? And when this one, which is relatively higher to more, but not that high as compared to this, was increased by 20%, the index was what at 5.93. Now, when this one, stock C, was increased by 20% here, making 60. All right, so let me making it 60 now. You can see that the index is now was sitting at 3.770. And then when stock D was the only one that was increased by the 20%, you can see that it's sitting at 2.9. So you can see that in the price weighted index, more emphasis are placed on stocks with higher prices when there's a percentage change in increase, like when price changes by a percentage. So you can see here that the prices that have higher price, the stocks that have higher prices affects the index more as compared to the ones that have what lower prices. So that is what it means here. Get it? And this is what I penned down during tutorials. So the result tells us that the same percentage change in price of the stocks, right? We can see that the ones with higher prices affect the indexes more than the ones with was lower prices, right? So the result tells us that the same percentage in price of a price of a relatively high price stocks. So the same percent thing in the price of a stock that has a relatively high price causes a large percentage change in the price weighted index than a relatively low price stock. We can see it from here, right? So let's move on to question 7. This is question 6. Question 7. So question 7. The table below shows the price of 3 stocks before a stock split. Stock A split 3 for 1. So here only stock A. We are only dealing with stock A. So stock A shows or stock A split 3 for 1. Calculate the value of the new divisor and why is a new divisor calculated after a stock split. So now they are telling us to calculate the value of the new divisor and why is a new divisor calculated after a stock split. and why do companies split their stocks? So let's put the same thing also here, like what we did, right? What we did up here. We are coming to just do the same thing here, right? So let's draw. Here we only have two. Now stock and have price. So here we name price before split. Okay. Price after split. We have stock A. And have price before and then after. So before split is what 30, 20, and then 10. Now, remember the example I used here. I use an example here where it was what 2 for 1. So for 2 for 1, the stock price was changed or was divided by 2. Here we are having what? And here we are having 3 for 1. So meaning that the stock price is going to what? Change by 3, like divide by 3, be divided by 3. So here we'll be getting 10, because 30 divided by 3 is 10. So, so 3 for 1 means that price will be divided by, it will then be equal to 30 divided by. So this will be 10. This will be 10. Because this one, then this one, they were saying that only stock A splits. So only stock A 10. Stock B will still be the same 20. Stock C will still be the same 10. Now let's put all the sum, the divisor, and set the percentage. Percentage, right? Where we know the sum is just the addition. Go to sum and add it. Then this one to add it. Right. Now the divisor here is what we have 1, 2, 3 here. 1, 2, 3. Right. And then we know that the index is going to be equal to this divided by this, right? It should make the index to be 20. Now, whenever there is a stock split, the index should not change. The index should still remain the same. So it should still be remaining at 20. Now, what we need to do is we have to find what a divisor that will make the index still look or still be at 20. That's our work. Whenever there's a stock split, the divisor doesn't change. The index doesn't change, but the divisor changes. So now, now remember that if you want to get the index, The index is equal to what? The sum or the total value of the prices, right? All over the divisor, right? Now, after stock split, we still want to maintain the same index to be 20. And then the sum now has changed to 40. Bring it here, 40. All over the divisor, we don't know. So let's replace it by x. Right. Now, what we are going to do is just the normal cross multiplication, right? So 20x is equal to 40. Now, divided by 20, divided by 20. And we are going to get x to equal to the divisor after the stock split is 2. So you can see that 2 also, 40 divided by 2 is 20. So that is it for divisor thing. Right. Now, the next question is that why do we calculate the new divisor? And then that's what I've explained. We compute the new divisor so that the index doesn't change. We compute it so that the index will still remain the same, right, after the stock split. And then the other part is saying that why do companies split their stocks? The reason why companies split their stock is what I've explained earlier. That the prices of the stocks may look significantly high. So they need to split their stocks and then cause what price to reduce. So in terms of that, other investors might be able to what invest in their firms. So here, companies may split their stocks to reduce the price, hence making it attractive and accessible to a large number of investors. Many investors feel intimidated by high stock price. Therefore, companies are likely to split stock prices when they get high, right? So that's why they split their stocks. So let's look at question 8. So question 8, the table shows the prices and the outstanding shares of different stocks across different time periods. Suppose in time t plus 1, the outstanding shares of t increases to 50,000, whilst the rest remains the same. And in time t plus 2, the outstanding shares of b increases to 100,000, whilst the rest remains the same as in period t. Suppose period t is the base period and that the base value of the index is 100. Calculate the value weighted index in period t plus 1 and period t plus 2. What does this tell you about evaluated indexes? So we are still going to do this. Maybe later you want this Excel sheet. And let me know. Send it to you. Go to 447 That's that. I'm not sure you need it because you get that last. So let's continue it. So we create a table just like this. Let's include this table. We'll have the stock. I'm coming to add the price here. Then you have number of shares. Then we have market cap. This at time T. Right. We have stock A, B, C, D. Now the prices are 100, 80, 50, and 40. Now the number of shares here is 5,000, 5,000, 5,000, 5. The market cap is then price times the number of shares. Market cap is equal to price times number of shares. It's equal to this times this by this. Right. And we are going to have a total here. Just sum the number of shares with the market cap is with some of them. Now this is the total here. This is the total market cap. Right now let's compute the same thing for time T. Let me just copy everything. Sorry, we are computing it for time T plus 1. So time T plus 1. Now, in time T plus 1, what did they say? They said that D share is going to increase to 50,000. So D, we are just going to add 1 0 to it. 50,000. So this, only D cell, only D is going to increase to 50,000. So we increase D 50,000. Oh, I forgot to do this. So the index here so the index here, they said it will be at 100. Right, that's what they said, it will be at 100. Right, so there is the market cap, adding all the shares, right? Now, here, only D has what? Increased to what? 50,000. And then now let's calculate the total right now. Total market cap. So here we are going to sum all of this. So now this is what we have now. Now we want to see the changes because look at what they said. So they said calculate the price, the value weighted index in period T plus 1, T plus 2, and then T plus 2. So now value weighted index, the formula is value weighted index. Is equal to the value of the stock at period T plus 1. So value, the new stock, new market cap, sorry, new market cap, new total market cap, new total market cap, all over, old total market cap times the index, or times the beginning index that they gave you, right? So now the new market cap here is what? 315, 3.3,150,000. So let's write it here. 3,150,000 all over. What do we get for the first one? 1,350,000. 1,350,000 times the index in the question. The index was 100. The index was 100. Okay. So the same 100. Then we are getting 233.3. So value weighted is equal to 233.33%. Right. So now the index for this one 233.33 is going to be the index. Now let's look at period what? T plus 2. 1 times T plus 2. Let us copy the same thing. Right. So maybe but they are saying that in time T plus 2, B will increase to what? 100,000. B shares is increasing to 100,000. So only B only B is what increasing to 100,000. So let's change this one to 100,000. Right. The value to what changed. Now the total going to be equals some the now index. You can pause the video and then find the index. Yes. So the index, I'm still using the old formula. It's going to be the new is 81950,000 all over the old one, the period T. Remember, we are always comparing it to period T. So period T was 135, so 1,350,000 times period T's index, which was 100, right? And we are going to get 66296. 660 point. That's it for time T's index. So the indexes, uh, right. So we've computed the indexes. Now, let's go back to the question. The question is saying that, what does this tell us? So this tells us that markets with what, or firms with higher market capitalization actually moves the indexes. So you can see from here, when this share increase, and then the capital market capitalization was increased to what, 2 million, or is yeah, 2 million. You can see the index was increased to 233.33, right? And when this one increased, and then the market cap of that particular firm increased to 8 million, we can see there's what, a very big increase. To mean that whenever the shares increases or the market cap increases, the value weighted index also what, increases, right? So that is it, and it is simple. What I penned down during tutorial was that the value weighted index reflects the total market capitalization of stocks included in an index. The outstanding shares of the company increases, so does its market capitalization increases, which has a direct impact on the value weighted index, or the value of the index. That's it. So now let's go to question 9. So question 9. The table below shows the market price and shares outstanding for a number of stocks, A, B, and then C. The price are 10, 15, and then 20. And the shares outstanding is 100, 10 is 1 million, 6 million, and 5 million. You can assume the initial value index to be 25. So whether price weighted or value weighted to be 25. Calculate the price index and the percentage change. So now let's draw our table again. So here in the table, wow, step 9. We are going to have stock We are going to have price. We are going to have number of shares. We are going to have market cap. We have stock A, B, C. This one is 10, 15, 20. And then the number of shares for the first one is 1 million. This one is 5 million. This one is 6 million. Okay. Then now the market cap basically is going to be equal to, I've showed you already, or I've got you already. Okay. It's going to be this times the number of shares outstanding. Like now, total. There is it here, right? So it is 20 million. Okay, 20 million. Now, they are telling us to calculate the price index. So let's sum this one. Because we have to calculate price index, let's bring in our old way now. So we'll have a divisor and the index. So divisor and the index. So the divisor here, we have three stocks, so three, and the index is going to be equal to the total divided by the divisor. See, they didn't tell us that there was any stock split or anything. That's why the index has changed. But if there was to be any stock split, we would have to find a new divisor whilst maintaining the same index, right? So now the index is what? 15. So here, A, the price index is 15, right? Now they say we should compute the percentage change. And I've also illustrated that percentage change is the new one, right? It is 15 over 25 minus 1 times 100. You can do this on our calculator here. 15 over 5. It's negative 40%. The percentage change negative 40. Right, that's the percentage change. So now B is saying that assume the free float for all stocks is 60% on the next trading day. What is the new value of the value weighted index and the percentage change. Use the initial index as the base index. So we are still using this 25%. So free float is basically like the available trading, like the available number of shares that can be traded, right? So this 100,000 that we are having here, only 60% is available. This one, this million, only 60% is available. This 5 million, only 60% is available. So since we've already found the market cap here, right? Now we can find the free float here, right? So the free float is 60%. So equal to 0.6 times the market cap. And so this is what we have. We can drag it and we get all of them. Right. Now we drag this this one first. So free float is equal to 60%. So if we want to get the value, we multiply the 60% by the market cap each share or each firm. That's what I just did here. This is what I just did. Now they say we should what? Calculate uh the value weighted index, right? Remember the value weighted index. What did we say? How how did I say we'll compute it? Is the new market cap over the old market cap times the index, right? So the same thing. That's the same thing I'm coming to do here. So the new market cap is uh this 120 million. So the new market cap after the after the free float is 120 million all over. The old one is what 200 million here. So this is the 120 million, this is the 200 million. 200, 200, yeah, 200 million times 25, which is the index. So calculator, all over 200 times 25. So meaning the indexes can change, the base index can change. We have to change. This is the price index. Now, value weighted index. Total 15. Now, they want us to find the percentage. Since it is 50-50, we are likely going to get this same percentage. But let me do it. So it's the same thing as 15. The new one over the old one, 25 times 1 times 100. Or you can do 15 minus 25 all over 25 times 100. You are still going to get the same. This one, you are still going to get -4. So this one is also negative. So that's what we computed here. So that's it for 39. Hope it's solved. I hope it's explanatory. If you have any problem, you can send it into the comment section, or you can still send me a DM. So, okay. So if you have any further questions, you can put it in the DM, or you can talk it in the comment section. So let's go to the next one. So I think for this one, for example, market timing and late trading, we've explained it. Mutual funds, okay, let me just talk about it. So here we are distinguishing between money markets and capital markets. So money market deals with short-term financial instruments, such as treasury bills and commercial paper. And it is typically low risk. So it's normally, it's used to trade securities that have less than 1 year lifespan. Right? So example, as I've mentioned, is treasury bills, commercial paper, and the likes. Whilst capital market is used to uh, trade, is more focused on long-term securities like stocks and bonds, which offers high returns and also high risk, providing long-term funding for business and government organizations. Also, mutual funds and then hedge funds. See, you can even see mutual. Mutual basically means that the money is pulled from large number of investors, right? Large number of investors in a diversified portfolio of securities. And they are generally available to the public with low risk. And hedge funds are like private. They are the same thing. They are pool of money, but they are from private sources, like some few people, and they are less regulated, and they apply more aggressive strategies. So they have high risk, right? And then they are limited towards investors, as I've said there, private people. And then the equity and then the board funds. So equity funds is the investment in stocks with the goal of capital appreciation, right? And also higher returns alongside the higher risk. While for bond funds, it is more of looking into like a steady kind of return. You will invest 50,000, and you'll be receiving returns on it. But just like for equity, you were also expecting the 50,000 to be increasing, whilst you're also getting the returns. So that's the difference in the an example of the bond can be the government bond and corporate bond, right? All right, and then we also have market timing and then late trading. As I've said, market timing is when you are trading based on the market trend. Like the market is moving upwards, upwards, upwards. You are thinking, say, oh, okay, based on this, market is going to continue going up. Then you trade or you buy. Whilst when let's say when you are seeing market to come down and oh, don't let me sell, then you predict the sell, then you sell, right? Whilst the late trading is when you place any trade after the market has closed, which is illegal, right? Yeah. And then stock index and then index fund. The stock index measures the performance of a group of stocks representing a specific market sector. It cannot be directly invested in, whilst an index fund is a type of fund that mimics the performance of a stock index. It copies the performance of a stock index, by holding the same assets in the same proportions, allowing investors to passively track the index performance. All right, so that is it for this. And then this one, which talks about Auntie Frances in my paddy paddy received 100,000 in remittance from her son Jeremiah. Jeremiah, money come your body. Transfer, you don't remember me say you go transfer something. Auntie Frances chooses to put the money she received to good use. She considers mutual funds to be an appealing investment vehicle, but she is skeptical due to her lack of experience in finance and investing. As a finance student at the University of Ghana, I got some conversation. Briefly explain to Auntie Frances some benefits of investing in mutual funds. So some of the benefits includes diversification, right? Because mutual funds have a lot of assets in there. So there's what diversification, which is going to what reduce his her risk. And also hedge fund mutual funds are managed by professional in the, like professional managers. So professional managers manages the mutual fund. So they are going to what make they are going to make relatively sensible kind of decisions concerning trades, which means that the risk that's involved in there is going to reduce. And also, uh, mutual funds is affordable because you can start investing in mutual funds with some more money and still have diversification. Also, it is liquid. Mutual funds allow you to easily buy and sell shares, making it simple to access your own money when you need it, right? So the last but not the least is that there is a growth potential when you invest in mutual funds because over time, mutual funds have the potential to grow your money through long-term investment in stocks or bonds, helping you to meet your financial goals. All right, so this is it for tutorial set 3. I will come soon and then do tutorial set 4. Stay tuned. Kindly don't kindly like the video, this video, and subscribe to the channel for more. And also, you see this particular, it's 10 questions. We use, I think, 3 weeks to do this. 3 weeks or 2 weeks. But I think I'm using one with some points to do this. Right? It's stressful. Just kindly like the video for me and keep. All right, see you some other time. Bye.